After studying this module, you shall be able to differentiate between operating leverage and financial leverage, distinguish between business risk and financial risk, understand the concept of combined or overall or total leverage, learn the computation and interpretation of degree of combined leverage, popularly known as DCL. Know the risk-return trade-off in using leverages and appreciate the application of leverage analysis. We shall commence the topic by studying operating leverage versus financial leverage. 1. Meaning. Operating leverage is the firm's ability to use fixed operating costs to magnify the effect of changes in sales on its operating income, that is EBIT, whereas financial leverage is the ability of the firm to use fixed financial charges to magnify the effects of changes in EBIT on EPS. 2. Relationship. Operating leverage shows the relationship between sales and operating profit, whereas financial leverage shows the relationship between operating profit and earnings per share. 3. Cause. Operating leverage arises due to the use of fixed operating cost, whereas financial leverage arises due to the use of fixed cost of financing. 4. Risk measurement. Operating leverage measures the business risk, whereas financial leverage measures the financial risk. 5. Factors. Degree of operating leverage depends on the amount of fixed cost, level of sales and profit volume ratio, whereas degree of financial leverage depends on the rate of return on investment and cost of capital of fixed sources of finance. 6. Interpretation of degree of leverage. If the degree of operating leverage is equal to K, an X percentage increase or decrease in sales will produce a K multiplied by X percentage increase or decrease respectively in operating income, that is EBIT, whereas if degree of financial leverage is equal to K and X percentage increase or decrease in operating income, that is EBIT, will produce a K multiplied by X percentage increase or decrease respectively in EPS, that is earnings per share. 7. Interpretation of high leverage. High operating leverage indicates that high fixed operating costs exist, whereas high financial leverage indicates that more fixed financial charges, securities are present in the financial structure of the firm. 8. Favorable leverage. If contribution is more than fixed costs, operating leverage is favorable, whereas financial leverage is favorable when return on investment, that is ROI, is more than the cost of debt used to finance business project. 9. Unfavorable leverage. If contribution is less than fixed costs, operating leverage is unfavorable, whereas financial leverage is unfavorable when return on investment is less than cost of debt used to finance business project. Now, we shall understand the business risk versus financial risk. Number 1. Meaning. Business risk refers to the chance a business's cash flows are not. 1. Meaning. Business risk refers to a chance when a business's cash flows are not enough to cover its fixed operating costs whereas financial risk refers to chance that a business's cash flows are not enough to meet fixed financial costs. 2. Cause. Presence of high fixed operating costs cause high business risk, whereas presence of high fixed financial costs will cause high financial risk. 3. Factors. Main factors affecting business risk are variability in factors relating to business operations such as variations in sale quantity or selling price, fluctuations in demand and input costs, level of competition in the market, whereas main factors affecting financial risk are increased use of debt, variability in interest rates, changes in operating income, that is EBIT, and movement in exchange rates in case of international borrowings. 4. Measurement. Business risk can be measured by degree of operating leverage, whereas financial risk can be measured by degree of financial leverage. 5. Interpretation. It implies the uncertainty or variability of operating income, whereas it implies the uncertainty or variability of EPS and the risk of insolvency due to use of fixed cost sources of funds. 6. High or low degree of leverages. A high DOL would mean higher business risk and a low DOL would mean lower business risk, where a high DFL would mean higher financial risk and a low DFL would mean lower financial risk. 7. Amount of debt used in capital structure. Business risk is independent of the amount of debt a business uses in its capital structure, whereas the more debt a business uses, the more likely it is to default on its financial obligations. Hence, we will have more financial risk. 8. Control. Business risk cannot be fully controlled as it depends on a lot of external factors that affect operations of a business, whereas financial risk on the other hand can be controlled completely by restricting the amount raised through fixed charge sources of funds. 9. Minimization of risk. Risk can be minimized by incorporating appropriate strategies to confront the internal and external factors which contribute to the risk, whereas it can be minimized by maintaining adequate amount of liquid cash, using optimum amount of debt in capital structure, and undertaking hedging using financial instruments. We shall understand the meaning of combined leverage now. The operating leverage explains business risk complexion of the firm, whereas financial leverage deals with the financial risk of the firm. But a firm has to look into the overall risk or total risk of the firm. Combined leverage is a measure of total risk. Operating leverage shows the effect of changes in sales level on EBIT, and financial leverage indicates the effect of change in EBIT on EPS. So, a firm having both operating leverage and financial leverage will have to see the combined effect of both the leverages on EPS. Therefore, combined leverage is calculated. It is a leverage ratio that summarizes the joint effect of the degree of operating leverage, that is DOL, and the degree of financial leverage, that is DFL, on earnings per share, that is EPS, for a given change in sales. This ratio can be used to help determine the most optimal level of financial and operating leverage to use in any firm. Now we shall discuss the meaning of degree of combined leverage, that is DCL. Let us first understand the computation part. Operating leverage is measured by the percentage change in EBIT due to a percentage change in sales, whereas its financial leverage is measured by percentage change in EPS due to the percentage change in EBIT. Thus, the combined leverage is measured by percentage change in EPS due to percentage change in sales. Degree of combined leverage, that is DCL, is equal to DOL multiplied by DFL, which equals percentage change in EPS divided by percentage change in sales, which is equal to delta EPS divided by EPS whole divided by delta sales divided by sales. Equal contribution divided by earnings or profits available to equity shareholders. Equal contribution divided by EBIT minus interest expenses multiplied by bracket start 1 minus T bracket close minus preference dividend. Equal sales minus variable cost divided by EBIT minus interest expenses multiplied by bracket start 1 minus T bracket closed minus preference dividend. Now we shall discuss the interpretation. If DCL is equal to K, an X percentage increase or decrease in sales will produce a K multiplied by X percentage increase or decrease respectively in EPS. For example, if DCL is equal to 4, then a 1% increase in sale will result in a 4% increase in EPS. DCL measures the total or combined firm risk. Total or combined firm risk is the variability in EPS. Total firm risk is equal to business risk plus financial risk. More the DCL, more is the total risk of the firm. A firm with relatively high level of DCL is seen as riskier than a firm with less combined leverage, as high DCL means more fixed costs to the firm. Now we will consider one illustration to understand these concepts. Calculate degree of combined leverage DCL in following cases. Case 1. Degree of operating leverage and the degree of financial leverage of Advita Limited are 2 and 1.5 respectively. Case 2. Over the last year, sales of Sakshi Limited has increased from rupees 20 million to rupees 25 million, while earning per share has risen from rupees 5 per share to rupees 7 per share. Solution. Case 1. Degree of combined leverage is equal to DOL multiplied by DFL is equal to 2 multiplied by 1.5 is equal to 3. Hence, degree of combined leverage of Advita Limited is 3. Case 2. Degree of combined leverage is equal to percentage change in EPS divided by percentage change in sales is equal to delta EPS divided by EPS whole divided by delta sales, divided by sales, which equals 7 minus 5 whole divided by 5 divided by 25 minus 20 whole divided by 20, which equals 2 divided by 5 whole divided by 5 divided by 20, which is equal to 0.40 divided by 0.25, which gives 1.60. Hence, degree of combined leverage of Sakshi Limited is 1.60. We shall now discuss the risk-return trade-off in using leverages. More fixed operating costs imply more operating leverage, which shows that higher the magnified effect of change in sales on EBIT, it leads to higher operating profits if operating leverage is favorable, or lower operating profits if operating leverage is unfavorable. that results in higher business risk. More fixed financial costs imply more financial leverage, which shows that higher the magnified effect of change in EBIT on EPS will lead to higher EPS if financial leverage is favorable, or lower EPS if financial leverage is unfavorable, that results in higher financial risk. More fixed operating and financial costs imply more operating and financial leverage, which leads to higher combined leverage, that shows that higher the magnified effect of change in sales on EPS, it will result in higher total risk. Now, we will consider the application of leverage analysis. Leverage is a double-edged sword. It magnifies profits in favorable conditions and magnifies losses in unfavorable conditions, producing harmful results in both cases. The impact of different combinations of operating and financial leverage are shown below. If both degrees of operating leverage or DOL and degree of financial leverage or DFL are high, then firm situation or total risk of DCL is risky or very high. If degree of operating leverage or DOL is high and degree of financial risk or DFL is low, then firm situation or total risk or DCL is normal or moderate. If degree of operating leverage or DOL is low and degree of financial leverage or DFL is high, then firm situation or total risk or DCL is normal or moderate. If both degrees of operating leverage or DOL and degree of financial leverage or DFL are low, then firm situation or total risk or DCL is ideal or low. Total risk measured by combined leverage should be kept as low as possible by keeping either both operating and financial leverages low. If operating leverage is favorable and financial leverage is unfavorable, keep DOL high and DFL low. If operating leverage is unfavorable and financial leverage is favorable, keep DOL low and DFL high. If both operating and financial leverages are unfavorable, keep both DOL and DFL low. If both operating and financial leverages are favorable, keep either DOL or DFL high, but not both, as keeping it both high will be very risky. Now, we will focus on the importance of leverage analysis. Leverage analysis is a significant tool in the hands of finance manager. The importance of leverage analysis can be explained as under. Number 1, it assists in taking investment decisions. Through operating leverage, a finance manager can assess the firm's ability to use fixed operating costs to magnify the effect of changes in sales on its operating income, that is EBIT, if an increase is in expected contribution is greater increase in fixed cost due to certain investment decisions, then operating leverage is favorable and investment decision will increase the earnings available to equity shareholders. 2. It helps in taking financial decisions. If rate of return on investments is higher than cost of fixed cost bearing securities, then financial leverage will be favorable and firm can use fixed cost bearing securities to increase returns to equity shareholders. Number 3, it helps in measuring business risk. Business risk can be easily measured through leverage analysis using operating leverage. 4. It helps in measuring financial risk. Financial risk can be easily measured through leverage analysis using financial leverage. 5. It helps in measuring and managing total firm risk. Relationship between operating leverage and financial leverage is multiplicative in nature rather than additive. Operating leverage and financial leverage can be combined in umpteen ways to obtain a desirable degree of total leverage and level of total firm risk. 6. It contributes towards goal of maximization of shareholders' wealth. The finance manager, with the help of leverage analysis, will come out with a financing mix and capital structure by which earnings available to equity shareholders can be maximized as effects of changes in sales on earnings available to equity shareholders can be measured. We shall now recapitulate what we have learned so far. Operating and financial leverages can be differentiated on the basis like meaning, relationship, causes, risk measurement factors, interpretation of degree of leverages, interpretation or high leverage, favorable and unfavorable leverage. Business and financial risk can be differentiated on several bases like meaning, cause, factors, interpretation, high or low degree of leverage, amount of debt used in capital structure, control and minimization of risk, degree of combined leverage that is known as DCL is equal to DOL multiplied by DFL, which equals percentage change in EPS, that is earnings per share, divided by percentage change in sales is equal to delta EPS divided by EPS whole divided by delta sales divided by sales equals contribution divided by earnings or profit available to equity shareholders equals contribution divided by EBIT minus interest expenses multiplied by bracket start 1 minus T bracket closed minus preference dividend equals sales minus variable cost divided by EBIT minus interest expenses multiplied by bracket start 1 minus T bracket closed minus preference dividend. If DCL is equal to K, an X percentage increase or decrease in sales will produce if DCL is equal to K, an X percentage increase or decrease in sales will produce a K multiplied by X percentage increase or decrease respectively in EPS. DCL measures the total or combined firm risk. Total or combined firm risk is the variability in EPS. Total firm risk is equal to business risk plus financial risk. More the DCL, more is the total risk of the firm. More fixed operating and financial cost imply more operating and financial leverage, which leads to higher combined leverages that show that higher the magnified effect of changes in sales on EPS, that will result in higher total risk. Leverage is a double-edged sword. Firms should keep combined leverage low by keeping either or both operating and financial leverage low. And lastly, leverage analysis helps in taking investment and financial decisions, measuring business and financial risk, managing total risk and Managing total risk contributes towards goal of maximization of shareholders' wealth.